Nifty company Trent, and the stock seems like it is down about 3.5%, down 20% from its peak itself. But these numbers aren't bad. Yes, slightly shy of street expectations, but here's what the street expectations were, Hormaz. 45% jump in the revenue and over a 60% jump in the profitability as well. What is the company reported? 39% jump in the revenue, 41% jump in the EBITDA, and 47% jump in the profitability itself. So, the numbers are slightly shy of very elevated expectations itself. EBITDA at 642 crores, the CNBC-TV18 poll was 675 crores itself. There's a 41% jump at a time when all other consumer companies are speaking about weakness in the consumption sector itself. Trent has gone ahead and grown its revenue by 39%. Yes, a few basis points, below street expectations, but you have to keep the consumer sentiment in perspective as well. So 39% revenue growth is what the company has reported, 4157 crores. The street was working with a number of around 4300 odd crores. 41% is the jump in the EBITDA, 643 crores. Here the street was working with a number of 675 crores. The net profit actually has been slightly below expectations, but that's on account of a couple of factors. If you look at, the overall depreciation of the company, that has increased, and that's largely because one of their, some of their storefront is increasing. Secondly, other income is down from 80 crores to about 47 odd crores. And thirdly, we also have the tax expense, which is up from 86 crores to 131 crores. So you account for all of that, that explains the miss on the bottom line. Operationally, it's largely in line, mildly below expectations, but that's only because it was extremely elevated expectations out here. We have Prakash Diwan with us. Prakash, we'll speak to you about M&M in just a bit, but Trent, 39% revenue growth at a time when everyone else is seeing consumer sentiment weakening. How do you read these numbers?
No, I think the numbers are far better than what could have been given the weak consumer sentiment, Mangalam. And you know how other retailers have been struggling not only to improve margins but also to grow revenue. But what Trent has done tells you that the juggernaut is on, their expansion, their single store sales contribution, all of that seems to be absolutely in line. I really don't think there's anything amiss. It's just that the stock is trading at such elevated valuation that the expectations around it are always going to be very high. So vis-a-vis that, it's going to look a bit weak. But if you look at on a YOY basis how they've improved, it's dramatic. So I don't think there's anything to complain. It's just that the market will have to digest these numbers and realign with the thing because of the PE multiples being so elevated.
That's what happens, right? When the stock runs up so much and then the margin for error basically is almost nil, right, Prakash? Because even after a 39% revenue growth, you'd see it fall short of expectations. What is it that you are expecting now from the company going forward? Do you see the execution needs to continue at this level as well for these elevated valuations to sustain?
No, absolutely. And remember, we've got the lab-grown diamonds bit also now becoming a vector. Of course, it's just early days for that. But as it kind of grows into a significant presence, there will be contribution coming from that side as well, at least in terms of revenue build-up. So you're right. Execution has been stellar. It will continue to be the pivot on which the growth hinges. But my sense is it's just the elevated valuation which was going against the stock. But the EPS growth will kind of help catch up to some extent. It still doesn't kind of become reasonable or come into a value zone, but at least there will be a catch up at lower levels of the stock and better improved EPS trajectory.
One of the metrics to look at, Trent, would not just be PE. You also have to look at the PE divided by growth, or the PEG ratio as one looks at it. If the company is trading at around 90 times 2-year forward earnings, growing EPS at around 47% itself, then the PEG ratio is at 2, which is still at par or better than a lot of the other companies which are trading at elevated valuations with not the EPS growth to show for. Thanks a lot, Prakash, for a quick take on Trent. We'll probably speak later in the day for your views on M&M as well. Take a short break now, continue our coverage on earnings.